Imagine a world where stock prices have absolutely nothing to do with profits. It does not matter if a company makes billions or loses billions. The price goes up simply because a computer program has a rule that says, buy. Now, imagine that 50% of the entire market is run by these mindless computer programs. If that sounds like a recipe for a disaster, you are not alone.
What waren diversified and there?
This is the index fund bubble theory. The idea is that by blindly buying the S&P 500, we have broken the mechanism that sets fair prices. We are inflating a massive balloon that is bound to pop the moment the flows stop. And if you have your 401k or IRA in a target date fund or a broad index ETF, you are sitting right in the middle of the blast radius. Today, I want to walk you through the mechanics of this risk. We need to look at whether passive investing is actually a ticking time bomb or if it is just a boogeyman invented by active managers who want their fees back. I have spent the last week digging into the research on this, looking at papers from the Bank for International Settlements and arguments from investors like Michael Burry. The answer is not a simple yes or no. It is actually much weirder than that. The market structure has changed, and if you are investing like it is 1990, you might be carrying risks you do not see. But the solution probably is not what you think it is. Before we get into the math, if you appreciate deep dives that respect your intelligence and your wallet, do me a favor and subscribe. It is the best return on investment you will get for $0. Now, let's look at the argument for why this bubble might be real. Here is the core of the fear. It starts with how an index fund actually works. When you give $1 to an S&P 500 fund, that fund does not analyze balance sheets. It does not call the CEO. It does not look at PE ratios. It just looks at a list. It sees that Apple is a huge part of the index, so it buys Apple. Only narrator speaks and lip syncs, all other characters keep their mouths closed, says, it sees Microsoft is huge, so it buys Microsoft. This is called price-insensitive buying. The fund manager effectively says, I do not care what the price is. I have to buy it. Critics argue that this creates a self-fulfilling prophecy. Because the fund buys the biggest companies, their prices go up. Because their prices go up, they become a larger part of the index. Because they are a larger part of the index, the fund has to buy even more of them next time.
It is a loop. And the fear is that this loop has detached the price of the biggest stocks from reality.
Let's put some numbers on this, because the concentration is undeniable. If you look at the S&P 500 today, the top handful of companies, the Apples, Nvidias, and Microsofts, make up a massive percentage of the total value. We are talking about 30% of the index, concentrated in just a few names. In the past, active managers would look at that and say, that is too expensive, I am selling. But an index fund cannot sell. It mathematically cannot sell. If Nvidia doubles in price, the index fund must hold twice as much of it by weight. Ah la la! The critics say this breaks the law of supply and demand. Usually, when something gets expensive, people buy less of it. In the world of indexing, when something gets expensive, the algorithm buys more of it. It effectively rewards overvaluation. If this theory holds true, we are not investing, we are just inflating a balloon. And the scary part is what happens when the air comes out. The psychological trap here is that, for the last decade, this has felt great. If you have been an index investor, you have looked like a genius. You beat the hedge funds. You beat the stock pickers. Why? Because the money flows were on your side. Every paycheck deduction that went into a 401k was a little mechanical bid pushing your portfolio up. But this creates a false sense of security. We start to believe that stocks just go up 10% a year by default. The bubble theory suggests that we are mistaking a structural flaw for genuine economic growth. We think the economy is booming, but maybe we are just seeing the result of trillions of dollars having nowhere else to go. It is like a crowded theater where everyone is trying to squeeze into the front row because that is where the cool kids are. But nobody is checking if the floor can hold that much weight. So that is the terrifying part. It sounds logical. It sounds like we are all driving off a cliff. But before you go and sell everything to buy gold bars and bury them in the backyard, you need to hear the other side. Because if you panic sell based on this theory, you are almost guaranteed to lose money. There is a very specific reason why the index bubble theory falls apart when you look at the actual trading data. It turns out the robots are not the ones setting the prices. You are about to see why your passive fund is actually a free rider on someone else's work. Let's look at how a price is actually set in the stock market. We tend to think that because passive funds own, say, 20 or 30% of the market, they control the price. But price is not set by who owns the stock. Price is set by who is trading the stock. This is the marginal trade. This is the marginal trade. Think of it like a house in your neighborhood. Most people in your neighborhood are not selling their house today. They are just living there. The value of your house is determined by the one or two crazy people down the street who are actually buying and selling right now. The stock market is the same. Even if passive funds hold a huge chunk of assets, they are not trading them very often.
They just sit there. No.
The trading, the buying and selling that moves the price up or down minute by minute, is overwhelmingly done by active managers, high-frequency traders, and hedge funds. These are the people setting the price. The research suggests that you do not need 100% of investors to be smart for the market to work. You actually need very few. There is a concept called the Grossman-Stiglitz paradox, but we can simplify it. Imagine a grocery store. Imagine a grocery store.
95% of shoppers, people like me, have no idea what a fair price for a gallon of milk is.
We just put it in the cart. We are passive price takers. But if the store tries to charge $20 for milk, there is that 5% of shoppers, the coupon clippers, the intense budgeters, who will stop buying. They will go to the store across the street. Their refusal to buy forces the price down. In the stock market, active managers are those intense shoppers. If passive flows push a stock price up to a stupid level, active managers will short it or sell it. They will force the price back in line. As long as there is enough active money to punish mistakes, the market price stays roughly correct. And right now, there is still trillions of dollars in active money watching every move. This is why John Bogle, the father of index funds, wasn't worried. He called indexing a free ride. When you buy an index fund, you are effectively saying, I am going to let the hedge funds and the active managers fight it out. They can stay up all night analyzing earnings reports. They can stress about interest rates. I will just accept whatever price they agree on. You are trusting that their greed will keep prices accurate, and honestly, greed is a very reliable mechanism. At least, if the index bubble was truly making stocks mispriced, if Apple was wildly expensive just because it isn't an index, they would be shorting the index and buying the cheap, ignored stocks. But when we look at the performance data, active managers are not crushing it. Most of them are still losing to the index. That tells us the prices aren't as broken as the critics say. However, we cannot just wave the efficient market flag and go to sleep. Because even if the index bubble is a myth, there is a very real, very dangerous side effect of everyone piling into the same trade. It is not that the prices are wrong. It is that the system is becoming fragile. The bridge is strong enough to hold the cars, but if every single car decides to drive in the exact same lane at the exact same speed, you get a wobble. And right now, that wobble is showing up in two specific places: concentration and liquidity. If you own an S&P 500 fund, you are taking a risk you probably don't even know is in your portfolio. Let's talk about concentration risk. Most people buy an index fund because they want diversification. You think, I own 500 companies, I am safe. But because the index is cap-weighted, meaning the biggest companies get the most money, you are not really owning 500 companies equally. You are making a massive bet on the top 10. Right now, nearly a third of every dollar you put into the S&P 500 goes into the tech giants. You are not buying the American economy, you are buying a tech ETF with some insurance on the side. This is not necessarily a bubble,
but it is a risk. If the tech sector takes a hit, maybe due to regulation, maybe due to AI slowing down, your safe diversified index fund is going to drop like a rock.
We saw this in 2000, and we saw it in 2022.
The danger isn't that the mechanism is broken. The danger is that the mechanism is forcing you to be less diversified than you think you are. The second structural risk is liquidity. I've got to protect this. But what happens if everyone gets scared at once? What happens if there is a recession and baby boomers start selling their index funds to pay for retirement all at the same time? The algorithm has to sell. It does not care about value, it just dumps stock. The worry is that because passive funds have become so big, a rush for the exits could cause a flash crash. Price discovery could break temporarily because there aren't enough active buyers to catch the falling knife. We have seen glimpses of this in moments of high volatility. Prices can gap down purely because of mechanical selling. If you are a long-term investor, this might not matter. The market eventually recovers. But if you need that money next week, or if you panic and sell at the bottom, the liquidity mismatch can hurt you. Now, the natural reaction to all this is to say, okay, Tom, I get it, the index is crowded. I will just hire an active manager to navigate this for me. That sounds smart. It sounds like buying insurance. But here is the trap. The data shows that when the market crashes, active managers usually do not save you. In fact, many of them do worse. Why? Because they are human. They face the same liquidity pressures. If their clients panic, they have to sell too. Plus, many active managers are closet indexes. They own the same big stocks because they are terrified of underperforming the benchmark. So we are in a tough spot. On one hand, the index is top-heavy and crowded. On the other hand, active managers and